Barbara Corcoran just dropped a bombshell that has real estate moguls scrambling and homeowners questioning everything they thought they knew about South Florida property values. The Shark Tank star and real estate legend didn't mince words when she painted a picture so grim that it sent shockwaves through investment circles from Miami to Tampa Bay. What she revealed goes beyond typical market predictions or seasonal adjustments. This is about fundamental forces that are quietly dismantling the foundation of what millions believed was America's safest real estate haven. The woman who built a real estate empire from nothing is now warning that South Florida's golden era might be coming to a screeching halt. Here's what makes this different from every other housing prediction you've heard. Corcoran isn't some academic economist theorizing from an ivory tower. She's been in the trenches for decades, watching markets rise and fall, seeing patterns that others miss until it's too late. When she speaks, smart money listens. And right now, she's telling anyone willing to hear that the warning signs are flashing red across the entire region. The numbers she's citing should make every property owner in South Florida pause and take notice. We're talking about price increases that have completely divorced themselves from economic reality. Over the past 4 years, home values have surged by percentages that would make even the most optimistic investor nervous. Meanwhile, the income needed to support these prices has lagged so far behind that entire professions are being priced out of the market. Think about this for a moment. Teachers, police officers, nurses, firefighters. The people who keep communities functioning are finding themselves unable to afford homes in the very areas they serve. When essential workers can't live where they work, that's not just a housing problem. That's a community crisis waiting to explode. But the affordability crisis is just the beginning of what Corcoran sees as a perfect storm brewing over South Florida. The insurance situation has reached levels that would have been unthinkable just 5 years ago. Private insurance companies are making calculated decisions to abandon entire regions, leaving homeowners with limited options and skyrocketing premiums. Citizens Property Insurance has become the insurer of last resort for hundreds of thousands of properties. When private companies refuse to write policies in an area, that's the market sending a very clear signal about risk. These companies employ armies of actuaries and risk analysts whose job is to predict the future. Their exodus from South Florida speaks louder than any press release or political speech. The insurance crisis isn't just about higher premiums. It's about accessibility. Try getting a mortgage when you can't secure insurance coverage. Try selling a home when potential buyers discover they'll need to pay $15,000 to $20,000 annually just to protect their investment. The mathematics become impossible for average families. Corcoran points to something that real estate professionals have been whispering about, but rarely discuss publicly. The price-to-income ratios in major South Florida markets have reached levels that exceed even the dangerous territory we saw in 2006. Remember what happened after 2006? The entire housing market collapsed, taking the global economy down with it. The difference this time is that we don't have the luxury of creative financing to mask the problem. Back then, adjustable rate mortgages and interest-only loans allowed people to buy homes they couldn't really afford. Today, buyers face high interest rates from day one, with prices that make the pre-crash era look affordable by comparison. What's particularly concerning is the demographic shift that's happening beneath the surface. Florida's growth model has always depended on attracting retirees and seasonal residents with disposable income. But the baby boomer wave that fueled decades of growth is aging out. Many are reaching stages where Florida's hurricane-prone climate becomes a liability rather than an asset. The younger generations that should be replacing them are finding themselves locked out by prices that bear no relationship to their earning potential. Millennials who watched their parents lose homes in 2008 are approaching real estate with a caution that previous generations didn't possess. They're not rushing into markets that feel fundamentally unstable. Meanwhile, the climate reality is becoming impossible to ignore. FEMA flood maps are being redrawn across the state, suddenly placing thousands of properties in high-risk zones that require mandatory flood insurance. Homeowners are receiving letters informing them that their previously safe property now requires additional coverage, costing thousands more per year. These aren't abstract future concerns. They're happening right now, creating immediate financial pressure on homeowners who thought they understood their carrying costs. When someone discovers their annual insurance bill has doubled or tripled, they face an impossible choice: pay the increase and sacrifice other necessities, or sell and hope they can find something affordable elsewhere. The investment community is already responding to these signals. Private equity firms and institutional investors who were aggressively buying South Florida properties just 2 years ago are quietly shifting strategies. They're not making dramatic announcements, but the data shows a clear pattern of reduced acquisition activity and increased selling. Smart money doesn't wait for crashes to happen. It positions itself ahead of major market shifts. The fact that sophisticated investors are becoming more selective about South Florida properties suggests they see risks that everyday buyers might be missing. Local real estate professionals are starting to notice changes in buyer behavior. Open houses that once attracted crowds now draw smaller, more cautious audiences. Properties that would have sold within days are staying on the market for weeks or months. Price reductions, once rare in hot markets, are becoming more common as sellers adjust to new realities. The most troubling aspect of what Corcoran describes is the self-reinforcing nature of these problems. As insurance becomes more expensive and harder to obtain, fewer qualified buyers enter the market. As buyer demand weakens, prices begin to soften. As prices decline, more homeowners find themselves owing more than their properties are worth, creating additional selling pressure. This isn't speculation or fear-mongering. These are observable trends that are accelerating across South Florida's major markets. The question isn't whether these forces will impact property values. The question is how severe the impact will be and how quickly it will unfold. Quickly it will unfold. The ripple effects are already spreading beyond residential properties into commercial real estate sectors that depend on a stable population base. Shopping centers, office buildings, and retail spaces are facing their own crisis as the underlying demographics that support them begin to shift. When families can't afford to live in an area, businesses lose customers. When businesses struggle, commercial property values follow residential markets downward. Barbara Corcoran emphasizes that this isn't just about expensive coastal properties anymore. The crisis is spreading inland to markets that were supposed to be the affordable alternatives. Cities like Cape Coral, Port St. Lucie, and Lakeland are experiencing their own inventory buildups and price pressures. These were the markets where middle-class families fled when Miami and Fort Lauderdale became unattainable. Now even these secondary markets are pricing out their target demographics. The construction industry is caught in an impossible bind. Material costs remain elevated from supply chain disruptions. Labor costs have surged due to worker shortages, and now they're building homes that fewer people can afford. New construction that should be adding needed inventory is instead adding to an oversupply of properties priced beyond reach of typical buyers. Developers who broke ground on projects 2 years ago, based on pandemic-era demand, are now facing completion dates in a completely different market environment. Pre-sales that seemed guaranteed are falling through. Financing for new projects is becoming harder to secure as lenders recognize the shifting fundamentals. The political response to these mounting pressures reveals just how serious the situation has become. State and local officials are proposing various interventions, from property tax relief to affordable housing mandates. But these measures feel more like attempts to manage a crisis than prevent one. When governments start implementing emergency policies for housing markets, that's usually a sign that market forces have already moved beyond normal correction territory. What makes Corcoran's assessment particularly credible is her track record of identifying market turning points before they become obvious to everyone else. She built her reputation by understanding not just current conditions, but the forces that drive change. Her analysis of South Florida focuses on the convergence of multiple negative trends that are reinforcing each other. The employment picture adds another layer of complexity to the housing crisis. While Florida has attracted businesses and jobs, many of these positions don't pay enough to support the inflated housing costs. Service industry jobs, tourism positions, and even many professional roles can't compete with housing costs that assume buyers have significant wealth from other sources. This creates a vicious cycle where the workers needed to support the economy can't afford to live where they work. Commute times increase, quality of life decreases, and eventually people make the difficult decision to leave for markets where their skills can support a reasonable lifestyle. The seasonal nature of much of South Florida's economy makes this problem worse. Markets that depend heavily on tourism and seasonal residents are particularly vulnerable when broader economic pressures reduce discretionary spending. If wealthy retirees and vacation home buyers become more cautious about Florida investments, the economic foundation of entire regions becomes unstable. Hurricane seasons add unpredictable but inevitable stress to an already fragile system. Each major storm brings property damage, insurance claims, and reminders of the risks inherent in coastal living. The psychological impact of repeated hurricane threats is becoming a factor in relocation decisions, especially for older residents who remember when these events were less frequent and less intense. The infrastructure challenges are mounting alongside the housing pressures. Roads, schools, water systems, and emergency services that were designed for smaller populations are straining under growth that happened too quickly. The cost of upgrading infrastructure gets passed along to residents through taxes and fees, adding to the overall cost of living that's already pushing families to their limits. Banking and lending institutions are starting to adjust their policies in response to these accumulating risks. Loan approval processes are becoming more stringent. Down payment requirements are increasing, and some lenders are becoming selective about which areas they'll finance. When the financial sector starts pulling back from a market, that's often the clearest signal that serious problems lie ahead. The timing of these convergent pressures is particularly unfortunate. Interest rates remain elevated, limiting refinancing options for homeowners who might otherwise be able to reduce their monthly obligations. Federal policymakers are focused on inflation control, which means monetary policy isn't likely to provide relief for struggling housing markets anytime soon. Barbara Corcoran's warning isn't just about property values declining. She's describing a fundamental restructuring of who can afford to live in South Florida and what kind of communities will emerge from this transition. The implications extend far beyond real estate into questions about economic sustainability, social stability, and the long-term viability of growth models based on endless population increases in climatically challenging areas. Barbara Corcoran's stark warning about South Florida real estate isn't just another market prediction. It's a wake-up call based on decades of experience watching bubbles form and burst. The convergence of unaffordable prices, fleeing insurance companies, demographic shifts, and climate pressures creates a perfect storm that even the most optimistic investors can't ignore. The evidence is mounting from every direction. Price-to-income ratios worse than 2006, essential workers priced out of their own communities, insurance premiums that rival mortgage payments, and smart money quietly heading for the exits. These aren't temporary adjustments or normal market cycles. They're fundamental shifts that signal the end of South Florida's housing boom. For current homeowners, the message is clear. The time to make difficult decisions is now while options still exist. For potential buyers, proceed with extreme caution and understand the true carrying costs of Florida property ownership. The paradise that millions chased is becoming a financial trap for those who can't see the warning signs. When someone with Barbara Corcoran's track record sounds the alarm, smart people listen. The South Florida real estate market's reckoning isn't coming. It's already here.